Now let's first talk about the trade on Wednesday, February 12th. I traded 30 ES future contracts. My risk was $4,500 and my risk to reward was about a 7-to-1, which means $4,500 worth of risk for about a $31,000 profit. Now for this trade to make sense, let's go step by step in my analysis and in my plan. The first thing that we have to be aware of is the market had CPI data at 8:30 a.m. Eastern Time, about an hour before the market opened up. It's very important to be aware of major economic data, major economic news such as CPI, FOMC, PPI data, job reports. Usually high impact news affects the market, and I find it provides high quality trading setups. Now, on this 8:30 news, the market aggressively dropped about 70 or so points. Now, in this very large red candle to the downside, what's significant to note here is pulling up a volume profile. If these terms are new to you, I would highly recommend checking out my order flow series. But during this very large drop where the market moved down at 8:30, we left an area where there was very little to zero volume transacted, starting at 60.60 all the way up to 60.75, where the volume began to transact at a much higher price. So on this drop, there was significant selling activity because the market didn't give a chance to really transact there at 60.60 to 60.75, and this was the basis to this trade today. Now, the reason why this is so important, and I introduced my target first, is because these levels where there's very little to no volume trading around, the market tends to gravitate towards them. The reason for this is because the market, what caused this large drop was an unfair chance, or for other participants didn't get a shot at really transacting here because there was no volume there. Now, the market likes to gravitate towards this to give other participants a chance to trade. Now, the market opens up, and right out the gate in the first 30 minutes or so, we have just a really, really strong rally to the upside. Since the market had this very strong rally to the upside and missed the level of resistance at 60.60, my thought process was to look for a pullback or look for an area where I can take the market long, speculating that this target at 60.60 will trade. Now, in very strong uptrending moves or even downtrending moves, I like marking out areas where the market consolidated or based, followed by continuation up or down. So around this 60-40 level is where the market consolidated. We moved up over here, we consolidated in this range, and then we had continuation up, missing our target by about 6 points. So my thesis and my plan revolved around watching and gauging the market around 60-40 was my level of interest. On top of 60-40 being a level where the market consolidated, pulling up the volume, we could see that there's a very large green bubble, which is a very large buying volume or trades hitting the offer directly at the 60-40 level. Now, as the market dips down into this 60-40 level, did not really see anything that indicated buyers were here, buyers were present, and buyers were strong to support this move up. Now, the market, as it's trying to rally out of this level, is when I formulate a plan to wait for this low to break at 60.36 and then reclaim above the 60-40 key level. So essentially is if this level breaks where the market put in this low, and then reclaims 60-40, I would then be interested in taking a long, targeting that high a day and targeting that 60-60 level that I mentioned that got developed from the CPI data. Now, another reason why I said this is because in this period from like 10:05 to even about 10:10 when the market consolidates here, in this quick 5-minute or so period, the market just was like a ping pong where it moved down, it moved up, it moved down, and it moved up. When I see something like this, I view it, especially in this context, in an uptrend, that someone is looking to leverage into a position or build up a larger move. The market's compressing that when it eventually breaks out, the breakout's going to be very violent and strong. And this is how I came up with my plan to long the market under this 60.36 level and then a reclaim of the 60.40 level. Break under, reclaim, target that level of supply. So watch what happens here as the market breaks this level. This is just a simple liquidity sweep, a simple fake out shorts to make them attracted to this move down, and then the market rallies up and I find enough confirmation to get long when the market breaks a level of support and reclaims it. It shows there's interest to the buyers and sellers are trapped here. So at this moment, I'm comfortable getting long, reclaiming above the 60/40s, placing my stop loss under this green line, and then going for that target at the 60/60 level of supply. And we get the very strong rally up right into the 60/60 level, and I take my profits off the table there. Now, the reason why I explained my target first is because of my conviction in these levels when they form. I know how these levels act like sort of a magnetic force or just somewhere the market tends to gravitate towards. Now, if I had to be honest, I most likely, and it's hard for me to say after the fact because I did take this setup, it's hard for me to say if I would have taken this long if I did not have this important level of resistance there. If this level was not such a magnetic force to the market, I may not have been so inclined to take the market long down here. But it's just the simple break of 60/36 trap sellers. Now, Carmine, how do I know sellers are trapped? Well, all I have to do is look at the volume, right? The volume as 60/36 was breaking. This is the low here at 10:06, 10:07, which from the candlestick chart, we could see the low here from 10:06, 10:07. As it broke, there was aggressive sellers, which is noted by the red bubbles or trades hitting the bid, filling and hitting a passive buyer, which is noted by the red and orange lines. So someone was selling into this move. This is a perfect liquidity sweep, perfect confirmation that sellers are trapped, and especially with all the green and the buying that came in directly after this sell-off under this liquidity sweep. And this is how I was able to have a $31,000 profit. Now, don't compare numbers, compare risk and points allotted. My risk was around 2 or 3 points for a 20-point target. If you trade one ES contract, a 3-point risk is only $150. If you trade the micro E-mini contracts, which is what I recommend a lot of futures beginner traders to do, $3 or 3-point risk on a $5 per point risk is only $15 worth of risk for a $100 gain. Now, on Thursday, February 13th, was a $25,000 profit. Again, 30 ES contracts, but this time I gained 17 points worth of profit, $4,800 worth of risk, and it was a 5-to-1 risk to reward ratio, longing a dip and longing a pullback to target a level of supply and resistance. Now let's go step by step on this analysis. The market on Thursday had PPI data. PPI data led the market to rally about 20 or so points. It was a little tame compared to the CPI data. But similarly, we left an area where the market had very little or no volume transacted around 60.78 to about 60.71. This was an area where we had very little volume transacted here. Now this coincides with the PPI consolidation low, and I dragged it down to where the market was trading at prior to the PPI data at 8:30 a.m. Eastern time. So I like watching levels where the market was trading at prior to data or prior to news. They just serve as important levels of interest. Now, my plan in the morning was to look for the market to sell off into this 60.78 to 60.71 level, now that you understand where that came from, to play the market long, targeting a level of supply, which was at 61.01, and we're going to have that on my charts up here. 61.01 was a level of supply. I was looking to long the market at this level of, I guess you could say, support to target this level of supply. Now, the issue is the market aggressively sold off, and on this dip down, I did not see confirmation to take the market long. A lot of traders were asking, why did you not take the market long here despite it being in your plan? And the answer is, or they were asking, what did I see? And the answer is, I didn't see anything, and that gave me enough information that me not seeing anything was seeing everything, if you understand what I mean by that. So because I didn't see anything, that was what I needed to see to tell me to sit on my hands. Now, I can't lie, I was sitting in FOMO a little bit because the market held this and bounced at it perfectly. There was no bids that filled down there. There was really no delta outliers. There was no absorption. There was really no strong selling activity. It was just a sharp, aggressive, violent sell-off to the downside and a very violent and aggressive rally and bounce from this level when the market held it perfectly. Now, the reason why I showed you the trade on Wednesday first was because there was a very similar volume pattern here when the market pulled back and held. So despite me missing this first rally, the market then pulled back around 9:47, which is this red candle, and then consolidated by about 5 minutes after this. Now, in this consolidation range, I was seeing the same volume patterns that I saw on February 12th at this 60.78 to 60.76 level. That if this 60.78 to 76 could now hold, I would be watching for an entry to take the market long. Now, unfortunately, I was a little too conservative. I was a little too trigger shy, didn't really see the best confirmation again there. And my issue with this day was I was being a little too conservative. I really wanted something to jump out at me so crystal clear, and it missed something because of my, I guess, bias or clouded judgment that I missed this rally up, and then the market moves up higher. Now, at this point, similar to the trade on the 12th as well, we come 4 or 5 points shy of this level of supply. So I missed the earlier two long entries off of this, and the volume patterns that I saw here at the 60.78, 60.76s was similar to what I just mentioned on Wednesday. It was an up move, a down move, an up move, down move that we just consolidated for some time before eventually lifting off. The day prior, we saw the market break this level and then reclaim it for a long. On this day, again, me being too conservative, I guess I was going with the intention of the same setup. I really wanted the market to break this, hold it, and then reclaim it. Instead, all we did was rally up, and it never gave me a shot to enter that I was comfortable with. Now, despite the market being so close to hitting this level of supply, we now get a pullback shortly after missing that supply zone, and on a 1-minute chart, we can see a lower wick where the market was bouncing off of 60.80. Now, in this process of the aggressive sell-off, we could see it highlighted by the aggressive red bubbles or trades hitting the bid or aggressive selling. The market sold off and then rebound. This rebound after these red bubbles is why and how this lower wick formed on the 1-minute chart. Now, in this process of the rebound, the market left an area of low volume sitting here at 60.84 to 60.82. If you've watched my most recent video, I talk about this strategy on the low volume. It's an in-depth video on it. I would definitely recommend it. But now we have this level at 60.84 to 60.82 that if this holds, I could be interested in taking the market long. Well, we dipped down perfectly into this 60.84 level, and I found good enough confirmation to try the market long at the 84s, going for the level of supply at the 01s, so it was about a 17-point reward for 3 points worth of risk, about a 5-to-1 risk to reward ratio. Now, the issue with this and kind of why I jumped the gun here, and I'm going to play this in real time, this is where I get confirmation. The area of low volume, right where my cursor's at, is being supported and is holding. So at this moment in this live replay setting, I'm comfortable enough taking an entry long with the stop loss under the low at this exact moment. And now really all I need to see to make this trade work out in my favor is large green bubbles or trades aggressively hitting the offer to come in. Now, the issue with this trade was I felt like because of the two trades that I missed prior to this, if I was a little too conservative, I may have missed this entry where I wanted to get long. The most ideal setup would have been a bounce off of 60.78 to 76s like I had mentioned earlier. But I felt like if I waited for the market to keep pulling back more, it may never get that pullback because I learned my lesson on the earlier two trades of me being a little too conservative. So it's kind of a double-edged sword. Yes, this trade worked, and yes, we rallied up into the supply zone, but maybe I was a little too risky with this, and I should have been a little more conservative. But because I was conservative in my previous two trades, I put a little more risk on here, not really waiting for the major level at the 78s or 76s to trigger. So I get long. Like I said, I was too conservative and I was missing entries earlier. The market sharply and aggressively pulls back into this, and then the supply level hit, and I got all out of that trade at the 6100s. And it was just simply off that analysis, simple and clean, longing sharp, aggressive pullbacks lower. It's been a common theme. And again, if you've watched my most recent YouTube video prior to this, I talk about this strategy. Sharp, aggressive pullback gets bought up, sharp aggressive pullback, gets bought up, sharp aggressive pullback right here where I entered long, gets bought up, targeting the level of supply, and that was that trade. So I'm going to end the video on that note. If you have any questions, if you have any comments, let me know below. And also, I would recommend following me on my Instagram. Again, the link for this will be in the description below. But other than that, I'm out of here. Peace out.